You're going to own nothing and be happy. That was their play. That's the globalist vision. I'm like, who buys into this?
We want people to think different. We want people to think it's okay to challenge these ideas that are beaten into your head by this conventional financial planning model, or as you term it, retirement Inc. Besides your immediate family, what is more important than your finances? All right. Hey, welcome back, everybody, to Remnant Finance. This week, I've got the pleasure of bringing back Joe Withrow, who many of you know. A lot of you have joined the Phoenician League. That's his investment strategy group. He has been through the ringer of ways that you can look at investing and understanding financial markets over the course of 20 plus years in the industry, and has created his own framework and his own, is investment league the right word? Is that the right term?
Investment strategy group.
Yeah.
At first I was calling it investment membership, but it's like, is anybody actually looking to join an investment membership? Like, what even is that? So,
Yeah.
What I really like, I feel like there's nothing else quite like this out there. So it's kind of its own thing. So
Yeah.
I like investment strategy group. I think that's a pretty good good description.
Yeah, because you can pay for education, and there's a lot of that out there, and you do have that. You have your monthly newsletter, which is just full of stuff. That's actually what we're going to review today. That you put out a ton of content, and you keep your members engaged and up to date on what's happening with actual analysis. It's not just headlines. And I've referenced quite a few of your thesis and analysis on the program before, and do so pretty regularly. But at the same time, there's also a kind of a core syllabus of your path to creating passive income and breaking from retirement Inc., as you call it. Last week, I think I mentioned that when the episode that hasn't come out yet, but will come out this coming Friday, Brian and I really went off on unfiltered tangent. So that's going to be an interesting one.
I can't wait.
But I said, it was like, everything from, you'll just see by the time this comes out, everyone will have heard it. So I said that, we've been talking about conventional financial planning in creating you could say the straw man. Critics would say the straw man of what that model does, and they say, hey, you're not actually giving it full due justice, and that's probably true. We're kind of summarizing and taking like the spirit behind what we see as the conventional financial planning model and comparing that to what we do. And of course, we present our side in depth, and we present the conventional financial planning side at surface level, and that's fair criticism. But we want people to think different. We want people to think it's okay to challenge these ideas that are beaten into your head by this conventional financial planning model, or as you term it, and I have decided we're going to use that term as well, is retirement Inc. It's a whole industry trying to herd you into this mindset,
And it's the strategy session I did. I know you were on there maybe 2 weeks ago now. Yeah. And I was kind of laying out the case, we have the very, very similar views on this. I know we're coming at it from the same angle. And there was a gentleman on there in the comments, and he was, I think he said he was 70 some years old. And he, that was his model, the conventional model. And he said, Joe's right. Like, I'm in such a difficult position because of these, this approach that I've followed without, actively considering, well, should I be doing this? Are there alternatives, or, that type of thing? It was nice to hear somebody say, yeah, you know what? It's because we talk about it in more hypothetical terms, and we can lay out the numbers too. But to hear somebody who's actually lived it for the entire duration of their career, and they say, yeah, this, if I had to do it, a chance to do it again, I would not do it this way.
Yeah, there's so much that we should have within our control and understanding that we've outsourced, and there's a way in the kind of the path and the structure that you lay out is a way that you can build resiliency and understanding your own assets, actually doing due diligence. Besides your immediate family, what is more important than your finances, because they undergird your family, your relationships. Like, when you have that peace of mind that this part of your faith, family, fitness, finances, friendships, like as Brian always talks about the 5 F's, like if the finances are secure, you are so much more free to focus on these other things. And so, just last unplug for the Phoenician League, like it's not only just here are some ways to think about it, but here's actual strategies. This is an actual investment platform or an actual investment strategy, and here is the person who's an expert that we can link you to teach you this, and then and here is the company to use if you want to explore this. And it's basically kind of putting out this sequential buffet of options and ways that you can actually get invested and involved and do the learning process. And then finally, there's the curated stock portfolio, which I've talked about how I use that. But I think overall, if you're interested, if you just feel like something's off and you're just kind of fell backwards into a 401k and you're just putting money into a retirement plan, which is not money, like money today is different than money in the future. Cash flow today, like there's value in saving for the future. We obviously are huge proponents of that, but like your 401k is not usable money. And so what could you be doing with that is a question you should be asking yourself. So we'll put a link in this, but the Phoenician League, just look for the link or email Joe, email us to get set up, and a lot of great value there. But what I want to talk about today is interest rates. Interest rates are something that have been in the news regularly. We're all hearing it. You see the president tweeting about it incessantly, and how setting as if someone knows what the rate should be
Right.
and can make that determination, whether that's Trump or whether that's Powell. And so a lot of people see these passionate opinions about interest rates and what Powell should do, and fall in line with, okay, yeah, well, I like Trump and therefore I think that he's right, and Powell, should be cutting rates. He's too late, Powell, whatever. So what I want to do, this was going to be a solo episode in line with my Know Your Enemies series. So this would, I think, be the 5th solo episode I would have done. I want to get into the weeds on this, because when you hear Powell should cut rates, I think for a lot of people, that just means at most they might think, okay, well, if rates get cut, asset prices go up because businesses can borrow more and therefore there's more money going into the economy. That's the kind of the standard central bank mantra. That's the main playbook is, if inflation's too hot, we raise rates because that lowers spending, which lowers prices. If inflation's low, we can lower the prices lower the rates, which increases the money. And so like it's just this inverse relationship, right? And so what does it actually mean? So as a little bit of an outline, I want to do a real quick refresher on what is central bank money versus commercial bank money. I want to talk about what is a repo, because this is extremely important when we're talking about these different types of rates. So there's reserves at the Fed, and there's a repo market there, and there's also reserves among banks. That's another repo market. And these terms get thrown around interchangeably because it is the same word, like the repo market, the rate, the interest rate. But there's a lot of different interest rates. I want to talk about LIBOR versus SOFR, and then we want to kind of bring it home with the idea that what might happen as a result of this change. And by the end, hopefully you can explain what LIBOR is, or was, and what SOFR is, and how that relates to Joe's primary thesis, which is, I'll let you kind of give your underlying thesis of what SOFR means moving forward.
Yeah, so it's really fascinating because we've kind of come to that whenever the Fed cuts rates, then just all interest rates go down. We've kind of imbued the Federal Reserve with this omnipotent quality that whatever it does, it impacts everything, and that's because for the better part of the last 40 or so years that has been true, but it hasn't been true organically. There's been other manipulations, and we can talk about that if you want. But up until 2022. We were on the LIBOR standard in the U.S. That was the benchmark interest rate here, from which banks would price loans, was LIBOR, which stands for the London Inter-Offered Bank Rate. London Interbank Offered Rate, I believe it is. But anyway, so LIBOR was a rate that was largely set by a consortium of very large banks. I believe there was 16 of them in total, and I believe
17 for the dollar.
17 in total, and I think it was 11 or 12 in the European Union, right?
11, yep.
11 in the European Union. So Europe had an outsized influence on setting the LIBOR rate. Well, every day the way it worked is the banks would just submit their assessment for what the interest rate should be, and of course they were supposed to base it on actual transactions or real analysis or something. But what we learned that especially in 2012, the LIBOR scandal hit the news, if you guys remember that, and that was kind of an outgrowth of the 2008 financial crisis. We learned that they were basically just spoofing the rate. They were setting that rate according to whatever they wanted the rate to be, and they were also trading it in various angles to profit directly as well. But anyway, so there are 3 key interest rate benchmarks in the U.S. The Fed funds rate, which the Federal Reserve controls. Then you've got what was LIBOR, Now it's replaced by SOFR in 2022. We'll talk about that more. And then the third benchmark is the 10-year treasury rate. And so the key thesis is the Fed only controls short-term interest rates. When it cuts the Fed funds rate, that does have an impact on short-term treasury interest rates, short-term treasury rates up to 2 years duration. It does impact the prime rate, which is tied to kind of small, kind of more short-term business and consumer loans. And then it impacts, savings account rates at the bank, money market accounts, certificate of deposits, if anybody still uses those, I don't know. But so it does have an impact on short-term rates. Anything above 2 years duration, including mortgage rates, for example, it's not tied to the Fed's funds rate. And so the only reason that the Fed has been granted or kind of seen as this omnipotent entity that controls interest rates is because there were other manipulations happening that would push longer term rates down when the Fed cut rates. And so the larger thesis, though, is since 2022, that's not been the case. And in fact, last year, Jerome Powell did cut, I believe he cut a full percentage point off the Fed funds rate. And guess what happened? Long-term rates went up. They didn't go down. And so that was kind of evidence that this is the case. So with the climate we're in today, the Fed does not control longer-term rates. There would have to be other manipulations that would be necessary to drive them all in the same direction. So I hope that makes sense, man. That's kind of a winding path to it.
Yeah, and if you're confused and you still don't understand some of these terms, that's what the purpose of this episode is. Like, there's the thesis. In one sentence, it's that the Fed no longer has the same influence. It does have an indirect influence, but it doesn't have the same control that we associate with when they determine the interest rate. Well, the market now gets a say due to SOFR. That's kind of the overall thesis. And so we'll kind of run through a few of these concepts here. And before getting into anything in detail, I know most of our audience hates the Fed, has read The Creature from Jekyll Island, which is why they hate the Fed. A lot of this, what we're going to talk about, we're coming from the approach of what is, like, what's the reality now. And so if we're talking, it's not like we're endorsing the Fed controlling interest rates. It's not like we're endorsing this concept of, fractional reserve banking. We're just telling you what is. What we give our opinions on it. But at the end of the day, this is going to persist, at least indefinitely. Things could change down the road. And this is actually a pretty big change that we're going to get towards our summary, like at the end, what we think this might mean, what we think they're actually trying to address here. But I think there are some potentially positive changes that this is making, and that the Trump administration, maybe it's all lip service. A lot of the stuff that's been exciting has been lip service, but hopefully if they follow through with some of it, like, there actually are some potential positive changes here. But at the end of the day, we're not like excited about
it's not
the Fed,
advocating
but like
these things. It's just
and actually,
analysis. Yeah, because
actually,
what I've learned is to set aside my preferences, and I've become a better analyst when I can say, well, no, they shouldn't do this. I don't want to, they should do this instead. If we set that aside and we just look at, well, here's what they are doing. Okay, so what does that mean? And what is that, how do we project that out? I think that helps you really understand, and I think for at least probably make better investment decisions as well, because these decisions do impact various investments in various ways. So it's not, not cheerleading for the Fed or anything, but or any of the other stuff that's happening, but it's just analysis that, okay, here's what they are doing. And here's what that, here's how we can kind of project that out and what that will mean for us as individuals as we try to, live our life. Because we're not psychopaths who want to control things and run the world or anything. We just want to live a nice life and raise our kids and, just enjoy the time we have here on Earth. So,
I just want a solar shed in the mountain and some independence. I actually I was reading your August newsletter today before I was going over my notes, just refreshing on some of this stuff. And I actually copied and pasted in my outline here. It was something else you were discussing, but it was that idea pretty well encapsulated. You said, but I'm just assessing the game board as it currently exists here so that we can gain clarity on what's actually happening. If we aren't objective like this, we run the risk of allowing our preferences to blind us to reality. Along the same lines, I also recognize that the U.S. government has already been supporting. This is talking about purchase of Intel, like buying that 10% stake in Intel, was what this specifically was referring to. But I also recognize the U.S. government has already been supporting private companies with huge sums of money for a long time now. It's not like we had free market capitalism before the Trump people came along with these ideas. But that idea, like, this is what is happening. These are the changes that are being made. can we find how we can optimize? I think is a good way to approach this. So
Yeah.
one reminder, if you remember from my central bank know your enemy, I think the first one, there's a difference between what we might call central bank money and commercial bank money, or broad money versus bank money. So broad money, central bank money is kind of like the I am this is like my analogy. It's not really, it doesn't make too much sense, but if you think of like there's 3 Walgreens in your town and you're going in to purchase something, or the pharmacy, like you walk in and you see products on the shelf. You have no idea what their stocking in the back is like. This could be the last one, or they could have 1,000 of them back there. Particularly like, think of the pharmacy. There's probably requirements for certain medicines, right? And that they have to have in stock, and they have to be, so like imagine that you're managing the Walgreens in your town, and you're shuffling around these reserve requirements because one pharmacy gets a ton of whatever medicine purchased. They have to move some around. Like, so those are all things that happen behind the scenes. All you know as a customer when you walk in is, what do you see on the shelf? Is it available or is it not? And what, can I get my prescription filled or not? Can I buy these chips or not? But behind in the warehouse and where all the stocking is done, there's a whole world that you're not seeing. And so that kind of analogy loosely is sort of how we can think about what we think of money as bank money. That's the money in our checking account. That's when we use a credit card and pay it off with our balance. That's and even when we think about banks, what they're doing, a lot of it is sort of that front end, how we understand money. But then behind the scenes, there's also central bank money, which is not dollars. I mean, it is denominated in dollars, but it's a different asset entirely. It's not something that's put out into the public and spent. That's bank money, and that's built off of these reserves. But when we talk about central bank money, we're talking about reserves that these banks have at the Federal Reserve, and they trade them overnight to each other to meet their requirements. If one has a lot more cash on hand, or they need more deposits, whatever it is, you can kind of think of like this back layer in the warehouse of these stock supplies being shifted around between banks. They're moving from one Walgreens to another, but you don't really notice that because that's outside of your view. And so when we're talking about the repo market, that is something that I'll read through some of this, and then I'll pause and let Joe elaborate. But the repo market, there's essentially 2 different repo markets we need to discuss here. One among these banks in the back room shuffling reserves at the Fed between each other, and one between banks. And that first one is really all the Fed is controlling. What's the rate on that aspect of it? So I think reading through this thing is valuable, even though I have the source here. But like, I think this wording is great, and then we can kind of talk on top of it from there. So it seems all. Do you have anything before I go on about that?
No, no, I'll let you.
All right.
I'm a better writer than speaker, so
All
it'll be
right.
better.
All right. It seems old habits die hard. A lot's being made in the financial world right now about President Trump berating Federal Reserve Chairman Jerome Powell and pressuring him to cut interest rates. The financial media jumped on this to drum up a story around it. Should Powell cut the rates or not? And is he stupid, like President Trump says? And bear in mind, this is from about a month ago when this was the peak of this decision. Now we know that he hinted pretty strongly that rates will be cut in September. So keep that in mind. This analysis is before we knew that, but so that's what the tone of this is. This drama is a complete distraction in my mind. With where we are today, it doesn't really matter much if Powell cuts rates. As I've mentioned before in these pages, his job is largely done. We've talked about the significance of SOFR replacing LIBOR on numerous occasions before, but mostly from a geopolitical event. Today, let's assess the situation purely from a financial standpoint. There are several key interest rate benchmarks that influence rate throughout the U.S. economy. They are the federal funds rate, secured overnight financing rate, or SOFR, and the 10-year treasury rate. So we'll pause there. I do want to talk about LIBOR before we get too far into it. And I have my encyclopedia of central banking section on here. I'm not going to read the whole thing, but there's a really interesting takeaway that we should talk about how LIBOR was calculated. So give us, you talked a little bit about LIBOR, and I'll read some of this from here. But if you have any more thoughts on that before I read this, or I can read this and we can kind of go through it from there.
Yeah, go for it, because that's
All
going
right.
to be more nuanced than me saying
Yeah.
they spoofed the rate. There was some actual calculation, so that's
Yeah.
but it's
And this is
highly
from 2013, and this is from a central banker's perspective. So like, this is a good thing that we do. And this is as the scandal was just breaking and the investigations were started. So fast forward 10 years from when this was written is when they phased in SOFR officially. and now LIBOR is a thing of the past. But at the time of this writing, it was not a thing of the past. So LIBOR, the London Interbank Offered Rate, dates back to 1984 when the British Bankers Association was assigned to construct agreeable trading terms and a benchmark for the growing market in syndicated loans that had sprung out of the euro currency market. The LIBOR was intended to reflect the rate at which banks were able to borrow from each other in the uncollateralized market. That's key there, uncollateralized interbank money market. A benchmark was also needed for the increasing array of financial derivative instruments that had become frequent tools for hedging and speculation alike. So that's important. One, uncollateralized, and you're going to cover why SOFR is collateralized and why that's better. And also just think about the mountain of derivatives that are built on an interest rate, and think about mortgages. Think about like all these things you
Trillions of
mentioned, right?
dollars, trillions
Yeah,
and trillions.
trillions.
Yeah.
Mm-hmm. So these are enormously important rates. But let's listen to how they calculate it to see like this is trillions of dollars of money that's moving hands, and this is how you do it. And it's going to remind you of something, I think, if you're pretty regularly reading financial news. LIBOR also had a prominent position in monetary economics as a symbol for the first stage of the monetary policy transmission mechanism. That monetary policy transmission mechanism is the way that they basically implement what they want through monetary policy. That's what we're seeing right now. That's just a central bank like staple is we use monetary policy to get the desired outcome. Okay, so this is honestly mind blowing. The LIBOR is determined daily by a panel of large London-based banks in a range of major currencies for maturities up to 1 year. Now, as we said before, the U.S. dollar rate, the LIBOR did different currencies, but for the dollar, 17 banks did this. 11 were in Europe, 2 were in Japan, 3 were in America, and 1 in Canada. So essentially, very heavily slanted to the interests of the European central banks. So those 17 banks, the actual fixing mechanism is straightforward. A designated calculation agent collects the submitted sealed quotes from the individual panel banks. During a short period, the calculation agent audits and checks the quotes for obvious errors and then conducts the trimming. That is the omission of the highest and lowest quotes whose number depends on the sample size. Thereafter, the arithmetic mean is calculated and published. What does that sound like to you?
It's
How they
ridiculous.
calculate inflation rates, right?
Yeah. Yeah. They take, where they remove what they don't want
Right.
and calculate it based on, a very heavily kind of like you know, the objective is already in mind. Here's what we want it to be. So how
Right.
do we make it get there?
The flaws in this are enormous. Let's go to inflation. The way they calculate inflation, the official government statistic, they send people out to grocery stores with a list of items, and they go and get those items. And this is for like food prices, for instance. They go and get those items and say what they would cost. But then they say, well, if pork, if beef got too expensive, consumers would shift purchase preferences to pork. So now that we see beef has gone up 80%, we're just going to assume that people don't want beef anymore, and
They're
now
not
they're
going to
going to
buy it
buy
anymore.
pork.
So they'll buy
And
something
look,
cheaper.
pork is only up 3%, and so therefore, let's just trim off that thing that doesn't help, right? And so the other way that they do it for home prices for inflation is they call homeowners. They call homeowners who aren't renting out their house, and they say, "Hey, if you were to rent out your house, what would you rent it out for?" And that's how they determine housing costs. Now Zillow exists, Redfin exists, Open Door, like these companies can tell you exactly what the market rate is in your, the appreciation of the price of homes and the appreciation of rent in your area in very specific real time undeniable data that exists. That mechanism exists to figure that actual inflation rate out. And Trueflation attempts to do that, right? That's a better
Yeah.
metric of inflation. But this government method is so bad because it doesn't matter what I say I would rent it out for. It's one, what I actually would rent it out for, and two, what someone would actually pay for it. So we can just
Yeah.
look at the rent rolls and see. We don't need to have homeowners guess what they might do. And
Hypothetical.
this was
Of course,
the
they've
the
not
inherent
thought about it all. If they're not going to
right.
rent their house, they've never thought about it for a second.
Yeah.
But
And so you have your banks, these 17 banks basically submit, I just imagine like a sealed envelope with like 5%, right?
yeah,
Well, that doesn't, that you put your money where your mouth is. Like, what are you actually charging? And so that system is so preposterously flawed and
yeah,
inherent subjectivity. And so the follow-up is although the LIBOR is an observable benchmark, the individually submitted LIBOR quotes do not need to correspond to the actual funding cost faced by panel banks. Straight up in the Encyclopedia of Central
Disconnected from
Banking.
reality.
Yeah, this doesn't have to have anything to do with what we would actually do. As the individual LIBOR submissions are not binding, the integrity of the benchmark is based upon the assumption that the banks reveal the truth. Now, they go into currently there's an ongoing investigation. Subsequent revelations highlighted that LIBOR panel banks had means, opportunities, and incentives to submit deceptive quotes. You don't think. Now, that is what LIBOR is. And that's why, and I think we're going to get into this, but why the Fed could make a monetary policy change by lowering rates. And now 17 panel banks agree and drop the rates. And so it looks like everything just, this is how it works. But it was manipulation.
And it goes back to, you remember 2008? I think it was 2008, late 2008, might have been early 2009. Whenever it was, everybody's best friend, Ben Bernanke, I know everybody remembers that guy, as Fed chairman at the time. And he goes on TV in the wake of the 2008 crisis, which there were all kinds of shenanigans that caused that crisis. It wasn't just something that just happened out of the blue. But he goes out and he says, we're going to have globally coordinated monetary policy. The Federal Reserve, we're going to work with other central banks and we're going to coordinate monetary policy together. We're going to collude to rig the game, basically. And if you look at the LIBOR banks, those 17 banks, I mean, you can see very clearly, if we're in an era of globally coordinated monetary policy, if they already didn't have an interest in going along with whatever, the central banks were saying, they would certainly have a ton of pressure to do so. Mm-hmm. And so that's what they did. And so the Fed would cut the Fed's fund rate, and that controlled, the short-term interest rates. And if LIBOR if those banks would just manipulate, or, I mean, they didn't even have to, if their calculation, if their submissions were just lower, it just drives those associated rates down as well. And so very much a coordinated effort to push interest rates down outside of market forces. And that's the thing. Market forces do have an impact, but that LIBOR kept, with LIBOR, there were no market forces based on what you just read.
Yeah. It's so crazy that was the accepted system. And I think that's before, I mean, in I think a lot of people, me and Brian's working relationship, how we met, a lot of our audience, everything has changed in the last 5 years. And I would be safe to say that a lot of your audience as well, like the fake pandemic, I think was kind of the driver for people to open their eyes on so many things beyond just the healthcare system. And so now, like, this is 2012, 2013. How many of us were, I was a flight student, like how many of us are tracking what LIBOR is, or, even thinking it's like, oh yeah, banks do things. I make my check, I pay my bills, I have some left over and I invest it. Like we're thinking on, we're playing checkers, and this is like not even in the same, they're not even playing chess. Like this is not in the same stratosphere. And so it's so far out of view, but now I think enough people are reading The Creature from Jekyll Island. They're understanding a little bit of what fractional reserve banking is and the perils of it. And so it's good that people are starting to learn this, but it's just now it's almost funny looking back, like reading this now with our kind of current lens and being like, wait a second, how did anyone accept that? It's the financial equivalent of walking into a restaurant. And I specifically remember this being a policy at a place in New Hampshire. And when you're sitting at your table, you had to have your mask, but when you had food in front of you, you could take it off. And then when you stood up, you put your mask. It's like full scale retardery, right? And I would imagine in 50 years, people are going to look back and be like, you guys did what?
How do you ever go along with that? If you're looking at that object from, even just now, but certainly 50 years from now, looking back, it's like, oh, so the virus doesn't get you when you have food in your mouth? Is that how it worked? Virus doesn't like food. I mean, it's just so objectively stupid. But everybody, not everybody, some of us didn't, but so many people just went along with it. And they said, oh, well, it's what I have to do, and that's it's just silly. But
it is.
Hindsight,
I enjoyed being like that bull in the China shop and just be like, wait a second, explain this to me and make it make sense. And I just didn't do a lot of that stuff. But anyways, okay. All right. So the Fed funds rate, and now, again, when Trump's saying, Powell, you need to lower rates, he's referring to the Fed funds rate. Okay. So the Fed funds rate is the rate at which U.S. banks lend reserve balances to each other overnight. That's the repo market where banks in the back room are shifting reserves that we don't see up front. That's central bank money. That's basically them just keeping their books good with the Federal Reserve, right? That's what the Fed funds rate is. At the close of business on any given day, some banks find themselves short on their reserve requirements while others have a surplus. And how could that happen? Well, remember, if there's a reserve ratio, and we always use the example of 10%, it's not 10% anymore, but if it's 10% the reserve requirement, you can have that leveraged out 10% reserves. You could have essentially 10x that of outstanding technically liabilities, deposits of consumers, loans, et cetera, right? But so if a lot of people take out loans and you approve those, you can approve it. You're just going to say, hey, we don't have quite the reserves that we need right now. So we're going to go to the central bank. We're going to have to buy some overnight. So that it's just a continuous every night resetting of making sure we're meeting these requirements. So these banks with a deficit must borrow reserves from other banks with a surplus. The Fed funds rate is the rate they pay on those loans to each other. When we talk about the Fed hiking or cutting rates, we're talking about the Fed funds rate. That's the only interest rate benchmark within the Fed's control. Now, the Fed funds rate directly influences other short-term rates throughout the economy, like the short-term treasury securities, prime rate, money market rates, savings accounts, certificate of deposit rates. If we look at this list, short-term treasury rates, that's up to 2 years, are probably the most important. The higher those rates are, the higher the U.S. government's debt service cost will be on new short-term debt issued. So, okay,
Yeah.
We'll pause there because there's a lot. I mean,
that's the core driver right now, I think, for why the Trump people are incessantly, wanting lower rates, because they came into this year and I believe it was over $9 trillion of debt needed to be rolled over, meaning Treasury bonds were coming due, or notes or bills. You can use Treasury bonds interchangeably, but they call shorter term Treasuries notes or bills, depending on the duration. But I believe it was over $9 trillion were coming due. So they have to pay whoever owns those bonds the face value. So it was over $9 trillion. They're running a budget deficit. They don't have any way to pay that money except for issuing new Treasury bonds. Mm-hmm. And so they came into the year knowing they were going to have to issue a lot of new Treasury bonds. And so the lower that rate, the lower the debt service cost will be, meaning the lower the interest payments the government will have to make, next year or in 2 years and so forth as it goes out. So I think that's a key driver with them, really harassing Powell to cut the Fed funds rate. And so
let's give an alibi here. Yeah, let's give an alibi here. Who was it that, like you've made the point that Powell has been trying to, one, reduce the Fed's or the economy's dependency on the Fed through SOFR. That's kind of going to be the summation of this piece. But at the same time, he was also offloading assets from the Fed's balance sheet. Yeah, which is a good thing. And who was going against him was Janet Yellen, right? Over her
she was
tenure,
doing Treasury buybacks at the same time that he was just letting, because he was not buying the Treasury bonds. And of course, I don't know if we made it explicitly clear the way the Fed could manipulate longer term rates is by creating money from nothing to buy Treasury securities at a rate at which no other market investor would be willing to accept. Now, some dumb investors like Bank of America were willing to buy Treasury bonds, large amounts of Treasury bonds at like 0.9% or whatever. Bank of America bought a ton at the lowest interest rate that has ever hit. So don't, if you have an account at Bank of America, I mean, they most likely get a bailout. But Bank of America I wouldn't use them if anybody does. But anyway, so the Fed was willing to create money from nothing to buy Treasury bonds at much lower rates than, an insurance company can't afford to buy bonds at 0.09%. It has to get some type of rate of return on its investment. Same with, other institutional investors. So anyway, that was how the Fed manipulated long-term interest rates lower. In 2022, that stopped. Jerome Powell stopped buying new Treasury bonds. And so over $2 trillion, and I've got a chart that I'll show sometimes on strategy sessions where you can see, you can go to, you just type in FRED, Federal Reserve Bank. I think it's Federal Reserve Bank of St. Louis or something like that. But they've got really good data on this. You can see how the Fed created, trillions of dollars over time to buy assets, mostly Treasury bonds, and over $2 trillion has rolled off the balance sheet. And so that's been happening since 2022. That's why rates normalized. It wasn't Jerome Powell hiking the Fed funds rate that drove up all rates throughout the economy, because again, that only impacts short-term rates. But he, at the same time that Powell started to hike the Fed funds rate in 2022, he also allowed U.S. Treasury bonds to roll off the balance sheet he bought. I mean, they might have bought some new, but on net, they allowed over $2 trillion to roll off. That allowed longer term rates to normalize because it
Mm-hmm.
allows market forces again to have an impact because investors who are presumably buying assets for their own benefit or for the benefit of their constituencies or their whoever it is, they need to have a real rate of return. Rates
Yeah.
can't be zero, or nobody would buy them. So this is the connection to this piece. Jerome Powell, I think, knew that. Why did he only start raising rates in 2022? He was appointed back in 20, was it 2016,
16,
28? I
yeah, I
mean,
believe.
yeah, I think it was 2016. He'd been there for a while. Why was it in 2022? Well, he actually started this process, I think, in 2019, and then the market tanked and had all the pressure because I think he knew that with LIBOR in place, LIBOR was in place until 2022. He knew that the European banks could just spoof the interest rates lower. And so even if he hiked rates prior to 2022, there's no guarantee that long-term rates would go up. And so SOFR replacing LIBOR changed the nature of everything. It disconnected the U.S. financial system from the interconnectivity to the global central bank consortium that had existed for however many decades previously. And so it's really fascinating when you look at it from that angle. Because at the time, you think back to 2022, everybody was just yelling at Powell, like, oh, he's raising rates and stocks are going down. And now my mortgage is, going up, all these things. They're yelling at him and just looking at, a very narrow perspective of what was happening. But the reality is it was a fundamental reorganization within the global financial system that liberated U.S. monetary policy from the spoofing of the consortium of the global banks, the large banks, and it implemented market forces again, or it allowed market forces to have an impact, I should say.
And that speaks to kind of your other thesis that we've covered on multiple calls with you, which is that this fight between American central bank, American New York banking interests, and European central bank globalists, like that is playing out. They're not on the same team anymore. And if you have to pick one of those two, like it's obvious that you want to pick Powell in the American interest because globalism is much, much worse. And so again, not that we're defending central bank, like the fact that we're having this conversation about, well, Yellen fire saled a ton of short-term treasuries that are now coming due. It's like nobody should have this much control. Like free market should actually be a thing, but it's not, and it's not going to
We've got
be.
all these problems because we didn't follow free market principles. So now we're in a mess, and it's factions fighting over, who's going to be in charge of that mess and what they're going to do about it.
Yep, and the mess compounds, and here we are. But at the end of the day, like we still want you to understand this, and so okay, so that you listed those things that the Fed funds rate directly influences. The other ones, I'm gonna skip past the explanation because I don't want to get too. I don't want someone listening to be too confused. But like prime rate, money market rate, savings accounts, CD rate. So those are things that generally track the Fed funds rate. But the most important one is that short-term treasury. So if you look at this list, if I look at this list, I just don't think these items are what's important right now. Cutting the Fed funds rate here will help reduce debt service cost on the $7 trillion worth of debt that the U.S. Treasury needs to roll over between now and New Year's Eve. That's those ones that's the conversation we just had. And given that debt pile, just a few basis points would make a big nominal difference if the Treasury has to sell a lot of short-term debt. But they would prefer to sell long-term debt if possible. And again, that's what Janet Yellen did. They're supposed to want to sell long-term debt. That's better for them. They were fire sailing short-term debt because Powell was not playing the game. He was going against the globalist agenda. And I think that Yellen and the Biden administration were patently anti-American and were trying to basically suck the U.S. into the European like nightmare that they're experiencing right now. And so,
I mean, that was their play in 2020. They used COVID to roll it out. Because when did we start hearing about World Economic Forum and Klaus Schwab? Most people had no idea these people existed until 2020. And they wrote out that commercial with some guy with a silly grin on his face, younger guy. And the headline was, "You're going to own nothing and be happy."
Yeah.
And that was their play. And that's the globalist vision. I'm like, who buys into this? Like, who wants that?
Yeah, I mean, look at England right now, and that's what they want. And
the jail if you make a Facebook post criticizing.
Yeah, exactly.
Somebody,
Yeah, I mean, if you fight off a rapist, you're going to go to jail for assault, not the rape. As long as the rapist.
Don't you hurt that rapist?
Yeah.
Hey,
as long as he's brown and he's not from your country, He's a
exactly.
protected person.
He's better than straight. But if he's not
Yeah.
those things, then you
Yeah.
leave him alone.
The class, and this that actually is kind of what our entire episode last week was about. But basically, like the two biggest selling points, it the love of like non-native and like if you're brown and non-native, you can literally rape with impunity because that surpasses to the liberal enlightenment mindset. You know that your law and sign liberals, the the active rape of a woman, which would be their like main shriek,
Right.
white supremacy,
That's
patriarchy, all this stuff, like that's
right.
drowned out if you're a brown migrant, because those two redeeming qualities, you're not from here and you have a different skin color, and that makes you untouchable to the lawn sign liberal. But anyways, back to
It's
interest rates.
just insane. But
Yeah. So cutting the Fed's rate, given that big pile of debt, a small basis point drop would change what they have to pay out on this debt. So that's important. But returning long-term rates to the market. This is the next part. We covered what LIBOR was. We're going to talk about what SOFR is. The secured overnight financing rate is the primary benchmark for trillions of dollars in corporate loans, adjustable rate mortgages, floating rate loans, interest rate swaps, futures contracts, options, derivatives, other structured financial products. So this the mountain of derivatives, the mountain of financial products that are impacted by an interest rate all rest on SOFR, not the Fed funds rate. Now, those two rates they kind of move in tandem. They can generally, but one is market set, that's SOFR, and one is basically Fed set, right? So SOFR is a critical benchmark for large corporate and institutional borrowing and hedging activity, and that extends into longer term financing. Often, this activity occurs when a company is undertaking larger scale projects. So, SOFR is arguably more important than the Fed funds rate when it comes to spurring larger projects that could generate economic growth. And here's what's critical about it: SOFR is based on actual transactions in the treasury repo market. The rate is derived from actual market activity. Now, contrast that with what I said about LIBOR, which is uncollateralized. All you have to do is put a number in the envelope. You don't actually have to follow that. Those don't have to be what you actually think the rates should be, or what the rates are, or what you're even going to lend at, or it has no bearing on reality. But with this, we're moving it to the field of reality, where this rate is actually okay. Bank of America and Wells Fargo actually traded at this interest rate because that's what they needed at the time. That's a data point that's going into this. It's actual market rates. It's I'm not going to give it free market. That's too loose.
yeah, it's
But
not
the term
exactly
free
free
market.
market, but it is a market there because you have
Yeah.
presumably self-interested parties who want to transact at the best terms for them possible. Therefore, they're not going to agree to loans at rates that, just that don't work for them, that are not advantageous for them. So it is a market rate, although this would not be how interest rates were set in a true free market.
At
But
least
anyway, there's market forces at play.
at least they're larping like there's some free market.
Yeah.
The treasury repo market is similar to the Fed's overnight window for banks. Okay, there's those two things again. The treasury repo market, i.e., what banks are actually trading with each other overnight, is similar to the Fed's overnight window, i.e., the backroom exchange of reserves, not coming out into the actual economy and being spent, the actual just exchanging reserves behind the scenes. So these two rates are similar, except the treasury market repo operation is open to many other financial institutions like securities dealers, investment firms, asset managers, money market funds, mutual funds, hedge funds, pension funds, sovereign wealth funds, insurance companies, and other institutional investors. So the actual economy is operating off SOFR.
Yeah.
Actual players that have to make real decisions, like an insurance company, says, "Hey, we are contractually obligated to pay out this death benefit. We need to grow our pool of capital, our general account, to meet our obligations. We don't get to say no. So we need to actually go to the treasury market and get returns commensurate with the risk we're taking, but also that reward us for the time value of money. So like in that case, that's actual free market, to the degree that we can have in this country. That is institutions with obligations and acting in their self-interest, which is good in the economy, actually needing to see these numbers, not just, well, here's what we would submit in an envelope, right? Now, this is going to get a little bit into repos. So, because again, that's a term that's thrown around a lot, but not something we really hear. So, when one of these institutions, i.e., all those real market actors I just mentioned, needs short-term funding, it can go into the repo market to essentially borrow money from another institution that's willing to lend. Again, this is an insurance company going to a bank. This is a bank going to a money market account, a money market account going to a hedge fund. These are institutions where they need to trade. The interest rate for that loan is determined by the two parties involved. Just to be accurate, these aren't standard loans. In a repo transaction, so in a repo transaction, and repo being a collateralized repurchase agreement, repo repurchase, basically, we're making a transaction here, and it's actually backed by something. And the borrowing institution sells U.S. Treasuries securities to the lending institution and agrees to buy them back on a specified future date at that price. That price difference represents the interest in a loan. Again, the key here is that these are market-based transactions in which self-interested parties determine the interest rate that they are willing to accept. The aggregation of all the daily transactions in the repo market is what establishes the SOFR rate. So can you just talk a little bit about the repo market? Like I used it, I defined it in a sentence, but like in reality, what's actually happening? Let's say we're both institutions. We've got Phoenician financing and we've got Stasi Capital. Like we're going to go meet in the repo market. What's actually happening here?
Yeah, so the big thing is that it's collateralized. Remember, we go back to what you read about LIBOR's calculation, uncollateralized, meaning no collateral involved. So here, the institutions that are needing financing or that are supplying financing through the repo market, the institution that needs to borrow, they've got to put up collateral, which is mostly U.S. Treasury securities. So that's an asset that is paying them an interest rate. Well, they basically say, hey, I will sell you this Treasury bond this price, and I promise I'm going to buy it back from you at a higher price, 2 weeks from now or whenever it is, at a specified date in the future. And so the way they raise money, it's not just a direct loan. It's they sell an asset that is the collateral. The other institution gets the collateral. They get paid on that collateral for as long as they have it, and then the borrowing institution at whatever date they agreed upon, they come back and they buy the asset back. And so they're buying it at a higher price. And so the interest rate, in a sense, is just the difference between what they sold it for and what they bought it for. And it's kind of a quirky thing, but that's how the system works. But the most important piece, though, is that SOFR, the interest rate, is an aggregation of all the transactions that happen. So everything gets fed in. They're not trimming anything out, as LIBOR did. And again, unlike LIBOR, these are market transactions that occur from presumably self-interested institutions that are trying to engage in finance to accomplish a certain end among themselves, opposed to, just to manipulate, rates in a given direction.
Yeah.
So that's the key difference. So SOFR very much is market driven, and that's why it's a whole different ballgame right now. That's really the core of it. SOFR has been so much more important than. And I don't remember seeing much at all, if anything, in the financial news or media about this. And I still hear, plenty of analysts who don't seem to understand that this fundamental change has occurred. And it's, we're not in an environment like we were before where, Fed cuts rates and all rates go down and then stocks are going to go through the roof. I mean, stocks still might go up if they cut rates. I'm not saying they won't, but it's just a different dynamic that we're in today.
Yeah. I want to do just a very like fourth grade example of a repo, like to put again, if like people that are not used to thinking in a lot of these terms, like let's say, all right, I'm going with my favorite baseball player. I got a Greg Maddux rookie card, right? And I want to keep my Greg Maddux rookie card, but I need $1,000.
Not Steve Avery, huh? Going with Greg Maddux.
Greg Maddux is my boy. So I know you're flush with cash right now. You don't need a Greg Maddux rookie card, and I want to keep it, but I need $1,000. And so I've got business coming down the road. I'm about to sell a contract, whatever. I've got income coming in, but right now, for whatever reason, on my balance sheet, I need to bump this up a little bit. And so I might say to you, hey, Joe, I'm going to sell you my Greg Maddux rookie card with the intent for $1,000, with the intention of buying it back from you for $1,100. Now, does the card even need to exchange hands? No, because it's just a contract, right? So the collateral is my card, my Greg Maddux card. If I don't follow through and buy it back from you in a week or whatever we specify, you don't get the $100 of interest that you would have gained because you send me $1,000. I notionally send you the card. I mean, I wouldn't mail it to you in this case. It's a contract. But if I don't send you the $1,100 and give you your 10% interest, well, you keep the card. Now the card transfers to you. And now physically it's a little bit different. I would mail you the card, whatever. But like we're talking about assets that are digital, essentially like these treasuries through the treasury repo market. So it's like easy for them to, the clearinghouses to work this transaction. But my goal is not to get rid of my I know that I'm going to be getting a $2,000 check from my business coming in a week, but I need cash right now. So you give me $1,000. Here's my Greg Maddox card. In a week, I'm going to come back to you and I'm going to pay you back, buy the card back, and give you $100. So you get $100 out of the deal for really doing nothing. You had the cash on hand. You just had to part with your $1,000 for a week, or a lot of cases, just overnight lending because they just need to balance books. That's essentially what a repo transaction is. That's why you say it's a little bit different than a normal loan transaction, where really all we're measuring here, it doesn't matter that $1,000 was exchanged. What matters was over the course of 1 week, the interest rate was 10% on that individual transaction.
Yeah.
And so if they're taking the net of all these transactions that are happening, it's like, depending how bad I need money, if it's like, I'm going to lose my house if I don't get this $1,000, I might offer you, hey, I got $2,000 coming in. I'll give you the whole $2,000 in a week. Here, I'll give you, you'll make $1,000. Just give me $1,000 right now. So like, depending on my level of need, that would be the interest rate that I would determine. But you can see how that actually translates to a market need that I have, and I'm willing to pay this interest rate. And therefore that is much more reflective of the actual economic environment for me and for you. Because maybe you don't have $1,000 to give me. Maybe you don't have reserves either. So I'm gonna have to go to somebody else. And of course, there's these broad, like enormous markets with all these individual actors. Some have balances plus, some are minus, surplus reserves. They're all exchanging with each other. And so it kind of nets out, kind of mutes these rate, like the people that are extreme, like, hey, I'll give you 100% return. I just need this money now. Like that's going to be averaged out. So we are taking an average here, but it's much more reflective than just me being like, Joe, what would you sell me this card for? It's like,
Right.
and you could just give me an envelope and be like, $200 is what I would pay for that. It's like, no, that doesn't mean anything, right? So the takeaway here is that SOFR cannot be set, nor is it tied to the Fed funds rate. SOFR is determined by market forces. This is why Jerome Powell replacing the LIBOR with SOFR was so revolutionary. You go into a little bit of I'm going to skip because we kind of covered the LIBOR here. And that brings us to the 10-year treasury. The yield on the 10-year treasury note is a critical benchmark as well. It's considered the global risk-free rate for long-term investments. The U.S. Treasury sells 10-year treasury notes to raise money to finance government spending. Investors pay a lump sum up front to buy it, and then the U.S. Treasury agrees to pay the investor coupon payments at a specified interest rate for 10 years. Obviously, the Treasury wants to sell these securities at the lowest rate possible, while investors want to get the highest rate possible. They have to meet somewhere in the middle to get the deal done. For this reason, the 10-year Treasury rate is seen as a gauge of economic growth and inflation expectations in the U.S. If investors expect low growth and or high inflation, they require higher interest rates to mitigate their risk. That makes the 10-year Treasury a benchmark for corporate bond rates, municipal bond rates, and mortgage rates. Specifically, the 30-year fixed mortgage rate in the U.S. closely tracks the 10-year Treasury rate. Here's the kicker. So the 10-year Treasury rate is also arguably more important than the Fed funds rate. Long-term borrowing costs track the 10-year rate, not the Fed funds rate. You also have on here, if anybody's on YouTube, this is that graph you're talking about, the balance sheet, where you can see the balance sheet trending downwards as of 2022. But I think the rest of it is kind of summing up the point you've been making. I'll jump down to this. It all comes down to this. We're back to an age where longer term interest rates are largely set by market forces once again. The Fed can still set short term rates. Remember, you highlighted that up to 2 years on the Treasury notes are a lot more reliant on the Fed funds rate, right? But not the 10-year. And the 10-year is really what, when we're thinking about, the interest rates of the like market cost of money, like we're really referring to the 10-year. The Fed can still set short-term rates, but it cannot control long-term rates now that SOFR is in place and QE has ended. And that's not theoretical. We've already seen it. Powell cut the Fed funds rate by 1% in the fourth quarter of last year, but long-term rates didn't go down. To the contrary, they went up. The 10-year Treasury rate moved steadily 1% higher after the Fed's cuts. Same thing happened when Trump's exact opposite. The same thing happened when Trump's big beautiful bill was announced, and the CBO projected that it would increase the deficit dramatically. Long-term rates went up in response. Specifically, the 10-year treasury moved about 0.5% higher. My point is, we're no longer in a world where Fed controls interest rates. Thanks to SOFR, in the absence of QE, and I skipped the QE part because that's getting just too detailed for someone listening who's kind of got a passive interest in this. But thanks to SOFR, in the absence of QE, long-term rates are now largely set by the market. The financial media and many analysts haven't realized this yet. Instead, they still see the world and make assessments through the lens of the previous era where all interest rates went down when the Fed cut the Fed funds rate, but that era is over. And that means any analysis stuck in the old framework will be faulty. Coming full circle, fixating on the Fed is now largely a distraction. How the U.S. Treasury manages the current debt wall and whether Trump administration can get the federal budget under control are far more important in my view. So that's the end of what I wanted to read from your newsletter. Again, everyone should subscribe, join the Phoenician League, and get these updates because the insight that we're getting here just helps you understand these, and all we can do is best understand and navigate to the best of our ability. And you can't do that. Like, you can't, if you don't understand, if you just see a tweet that Powell, Trump says that it's too late, Powell, he should have cut rates a long time ago. You should understand what that means and why, and you should also understand why that may not be the case, why that's not necessarily.
And just a tangible example. And this is kind of real world because I've talked with some guys who are looking at building a house, and of course you can't lock in a long-term rate on your construction loans until you're at a certain point in the process, and I forget exactly when it is. But anyway, rates are you can't lock in a fixed rate. But a lot of times, what you'll hear is the real estate people or the person that's doing the financing, they'll say, "Oh, well, you can just refinance when rate goes down. Fed's going to cut rates in September and probably again later. You just refinance after that." And if you don't understand that, well, maybe the long term, that doesn't necessarily mean that mortgage rates will go down if the Fed cuts rates. If you don't understand that, you'll be much more, I guess, likely to say, "Oh, okay, that makes sense. I'll sign on the dotted line." Whereas if you do more analysis and you understand, well, maybe they will go down, but maybe they won't because it's not guaranteed. Which just can implement. You can use this analysis in real world decision making as well, which I think is, that's important because we've been in a world for so long where everybody just assumes that you'll be able to refinance your mortgage down the road, but will you? Maybe not. I think it's just important to be critical. I think critically.
So what do you? So what do you see playing out? I said that we'd kind of go into at this point we're going from observable past and reality, and kind of like definitions and stuff to speculation. And so this is just Joe's predictions, or you're not held to anything on this. But how do you see this shaking out? What do you think might be in the works?
Yeah, well, we've got breadcrumbs that are happening. Everything's happening so fast. So they just the Trump team, or I guess President Trump himself, appointed an economist by the name of Stephen Moran to the Federal Reserve Board of Governors. Trump had previously appointed this guy to the Council of Economic Advisors as well. And if you look into this guy, he wrote a paper called, I'm blanking on the title. We can get that. It's like a user's guide to, I should have had that before we came. We'll get that in a minute. But anyway, this guy wrote a paper.
User's Guide to Restructuring the Global Trading System.
Yes. And so this guy has a very detailed, very long academic paper about restructuring the global trading system. Not exactly the most humble paper to write, that you could write, but it's clear that they're very intent on basically trying to devalue the U.S. dollar in global markets to make U.S. manufacturing more competitive. And they see, they want a reshoring of the manufacturing system in the U.S. They want to create more manufacturing here to secure the supply chain. They think that it would create higher paying jobs and wages would go up, all these things. I don't know if they're correct about that or not. I do like the idea of having American manufacturing, but I also recognize that, when you start getting into any form of central planning, it doesn't matter if it's right wing or left wing or whatever, there's going to be second and third order effects, and we can't say for sure what those are going to be until they happen. So this isn't advocating, nor is it saying that this is a bad idea either. It's just, I'm just kind of looking at, well, this is what they're doing. And so part in that paper, though, Moran also did talk about keeping a cap on longer term interest rates. They want lower interest rates. That's very evident. And so there's various ways they could do that, including QE or some, new version of QE. So there's a chance. So Jerome Powell's tenure at the Federal Reserve as chair is up in next May 2026. So he's not going to be there much longer. President Trump will be able to appoint his replacement. And what I think they've set up is a narrative to where they're suddenly calling into question the the validity of Federal Reserve independence. And that's whether or not the Fed's been fully independent of politics is another question in and of itself. I'm not sure that it always has, but they do tout, hey, we're independent of politics. The president doesn't tell us what to do. We set our interest rates based on, inflation targets and employment targets and these types of things. We look at the data. They've talked about that for a long time. And I think the Trump people are trying to call that into question, specifically to kind of give themselves ground, maybe to reassess or assert more control over the Federal Reserve to make it in alignment with their own policies. So all that's to say, there's a chance that after next May, we will see a Federal Reserve that is more active in trying to manipulate longer term rates lower. We're just going to have to assess that situation as it plays out, because who knows what that looks like. But for the time being, the Federal Reserve does not control longer term interest rates. And I tend to like that, Hans. I like the idea of market forces having an outsized impact in interest rates. I mean, I think that's how it should be. So I do like seeing this in the current climate, but there's a chance that as of next May, we might see some major changes to the system.
Yeah, and we got to remember there's 7 governors of the board of the Federal Reserve, which is made up of 13 different banks across the country.
Yeah. Yeah.
It's kind of initially was a sort of decentralized system, and then in 1935 they added basically, I believe, the governor position in this board of governors.
It didn't exist. It was a Treasury secretary that was chair of the board prior to 1935. And so they, but it's still each independent regional bank was doing their own thing. So it wasn't like the Treasury Secretary was controlling monetary policy. That 1935 was an element, and that was under FDR. And those guys, they pushed an element of centralization that didn't exist prior to. And so that's.
But those 7 governors are appointed by the president, and they serve 14-year terms, right? And so we lump all of this as Trump versus Powell, and Powell is of course the figurehead. Just like Trump's not making a lot of these decisions, his Council of Economic Advisors is putting all of these things together, and then he's the figurehead promoting it. Now, of course, compared to the previous president, he actually can think and form sentences and give opinions, and has a pretty strong economic understanding. And so there is an element he has a lot of these strong opinions that I'm sure are more pervasive within the Council of Economic Advisors than maybe other presidents who've been I'm not an economist, so but he's a businessman in a sense, and it seems like he's running it like a business. But we got to remember these Powell's one vote when they're talking about these things. Powell gets a vote the same as the other governors, and those governors have been there for up to 14 years, spanning different administrations. And so I've heard that the staff, the economists, the thousands of people that work at the Fed are almost exclusively left leaning, and so it's no surprise, I don't think, to anyone that overall inherent in a centralized central bank, that is the pinnacle of socialism, is having a central bank that controls the economy.
Yeah.
And
it's in the Communist Manifesto. You got to have a central bank. It's right there.
It's the first step. Yeah. So inherently, I think it's going to act from a liberal perspective, but Powell himself is a registered Republican, and these board governors have been appointed by the president over the course of the last 14 years. Everyone is currently serving. And so it's kind of I think that generally the idea of Fed independence is kind of more of a talking point. In reality, I think a lot of these pressures, it's clearly it feels like Powell's gotten beaten down. Maybe we have a different analysis in a year when we learn more, but it just kind of feels like he kind of waved the white flag at Jackson Hole last week and announced that he's going to cut, even though personally I am of the belief that the rates need to stay higher for longer, because it's yes, short term it feels good. Asset prices are going to go up. Your Bitcoin is going to skyrocket when the rate cuts come. On the announcement of a potential rate cut, not even saying we're going to cut rates, just saying we're going to review our policy. Everything just shot up. I mean, that's not free market economics, right? That is intentional manipulation. That's inherent to the structure here. I think that we need the fever break of this is going to fall apart if we keep doing this. We can kick the can down the road. We can take some over the counter, fever medication, but like the toxins are building up. And so I think it's short sighted to cut rates with just because you want your asset prices to increase,
Yeah.
because inflation is not, I don't think it's stopping, and employment is getting worse. So like, I don't, I don't like this idea that they're just going to cut rates because people want to see the stock market go higher.
Yeah.
Like, I think that's very
And
short-sighted
it
personally,
is
but
so short-sighted too, because there's also certainly a demographic. If you think of people who are retirement age, who in the old days they could work and they could save their money, and they could save their money in those things we talked about and I kind of joked about earlier, but like savings accounts at the bank and CD, certificate of deposits, that would pay a rate of return, or they could park their money in treasury bonds if they wanted to, and actually generate a return on their money, and they could live on that interest. I mean, that was the name of the game for a while, was you just earn interest on the money you've accumulated over your working year, and you can only do that if there's actually interest rates, and so that it does disadvantage people who want to just save money and be able to earn a rate of return if you're cutting rates, and because they're not, people of retirement age shouldn't have all their money in the stock market, in my opinion, so
mm-hmm.
that's it's what I mean. All we're talking about here is kind of picking winners and losers, and that's true of all forms of central planning, right? It's just there's winners and losers, and we do that analysis to make sure that we try to be on the right side of the coin, and certainly so that we don't get steamrolled. But there's benefits to higher rates as well. It also discourages malinvestment in the economy, meaning when rates are higher, people aren't going to finance dumb projects. And I'm drawing a blank one. Maybe a good example is all these NFL stadiums, and they just tore down. I forget where it was. Was it New York or New Jersey? They just demolished this $100 million stadium that was in use. It was still working. Nothing was wrong with it, so that they could build a $200 million stadium right next to it. And it's like, is that a good use of capital? And if interest rates, and they did this a number of years ago when rates were effectively zero, if we had market-driven interest rates where you had to make a conscious decision to borrow money at a higher rate, would that have happened? I don't know. Probably not. Maybe, but anyway, the point is, it's like lower rates also encourage people to do things that might not be wise, and that they might not choose to spend their capital in that way if rates are higher. So anyway, that's the other side of the coin too that I think we should be mindful of.
Yeah. Well, end of the day, we don't get a say, so all we can do is learn and try to adapt. And so that is Joe's thesis about how the Fed has essentially not even lost control, almost given up control, severed the dependency, I guess, the connection to their ability to make these broader market forces. And it's almost like they had to cut the tie from the EU, and it's like they might, that's going to hurt them a little bit, but at the end of the day, in the fight between EU globalists and New York banks, it's like you might have to take some hits and lose a little bit of control, but the other option is just being dragged down with the Titanic there. And so I think that some of the changes we're seeing are positive. I want to give another plug for and Joe, you can talk a little bit about where people can sign up for the Phoenician League. I know you just finished a kind of a membership drive there, but if anybody wants to reach out.
Yeah, just feel free to reach out by email. Our membership portal is membership.phoenicianleague.com, and Phoenicians, PHOENICIAN. It's a play on the ancient Phoenician commercial civilization, and as well as the Hanseatic League. So that's where the name comes from. But we're doing this type of analysis in the Phoenician League, and we've got a whole host of investment strategies that we advocate. We talk about tax strategy too, which I think is really important. And we actually talk to people, and we'll do strategy sessions with members if they're interested in that type of thing. We're not licensed financial advisors, nothing like that, but we can talk to people. We can have conversations, and we can say, well, here's how the resources we have, here's how the network that we have, it might be able to work for you. And we can say, well, focus on these areas here would probably make the most sense. So, that's something that I have not seen, in the financial world. Not many people will talk to you and actually give you objective thoughts. And that's one thing I love about the work you guys do, Hans, because I know I've sent, some people, referred some people to you. And if, you talk to them, and there's some people who come and they might be in a situation where, IBC will work for pretty much anybody, but there might be a thing or two first that you need to get in order. You might need to get your house in order first. And I know you guys will be honest with people and say, hey, yeah, really work on this piece first, and then let's talk again, after that. And so it's,
Yep.
it's, I think having that just a professional, assessment that's honest and transparent and interested, it's because this is our thing, we want to create a world in which people are financially independent, and we want to create a world in which people are, mutually collaborative, and we can, fall back on the network, we can work together, and that's important. And part of that is just being, having the support network and having the transparency built in. So that's rambling a little bit, but what we're really doing is trying to build, an ecosystem here that can counter some of the stuff. I've been immersed in the investment research space, and I see some of the marketing. It hasn't been as bad recently, but it's a lot of it tries to appeal to like base level greed, which really, bothers me. Like trying to tell, oh, you're going to make, 1,000% if you get in now, and then imagine you can buy this fancy car or all these things. And I'm like, I have no interest in any of that stuff. Yeah. I have no interest in consumerism. So all that's to say we're different, and I love working with you guys because I know we're on the same wavelength with all of that. What's actually important, and that's what we're going to support.
Yep. I know you do IBC yourself, and it's part of kind of your core content. It's so yeah, we've had a great working relationship, and I think that if this kind of conversation is interesting to you, or you think I'm not proficient, I can't speak economics well enough, I think that definitely get in touch with Joe. And the other thing, quick plug for, we mentioned last week, but this the low stress trading, this options strategy for the 1% a week target gain is potentially a game changer, and just shatters everything that we talk about when we think of how we want to grow our money. And of course, our financial order of operations and priority is protect, then save, then grow. And our big critique against Retirement Inc. is that they just focus on the grow at the exclusion of the others for the most part, or at least brush over the others, get a quick term policy, save, $10,000 in emergency fund, and then we're all just focusing on growth. And so we always start and anchor at those first two, because that's what our product is specifically tailored for. But on the growth side of things, if we're able to average 1% a week, that's a 68% annualized return. Unbelievable. And so, Brian and I are still.
Great strategy. It is such a great strategy. I was doing this 10 years ago with monthly options. Weekly options, I don't remember them being a thing.
They're new.
And it's just not as lucrative with monthly, but with weekly options, it's incredible. And so I'm doing this too. And in fact, I'm going to join the low stress trading system myself. I was talking to Brian about it last week, and it's just, I already know the strategy works, but these guys apparently have something that's really robust there. So I'm going to check it out myself, man. That's great.
I tell you what, man, like it's opening, I spend all of my waking hours that I'm not directly with family, like thinking about what we're doing specifically, and trying to learn as much as I can in an effort to be as knowledgeable when I talk to clients, and also being able to talk competently through these things. Like I pretty much all of my free brain power goes to finance and economics, and I spend a lot of time thinking about the future. And this, more than anything I've seen since learning IBC, is such a game changer that has me so excited for the potential of what life can look like in just say 5 years. This is going to, not that we believe in the retirement paradigm, not that we're, if you remove how can I retire at 65 and all efforts going towards that being the primary goal, if you just remove that from your planning, you don't have to stress, because you can always do things to earn income. You can set up these passive income streams to where you can work the amount you want when you want. You can set up freedom, but we're not just building towards this, like I'm going to start just kick back in a lazy boy at age 65 kind of idea. And so, but this opens up the idea of like, I could retire at 43 effectively and have most needs covered between these different strategies and build this robust, like I'm not going to do solely this options play. I also have a lot of the assets, like my asset allocation tab on my spreadsheet basically mirrors the Phoenician League strategy. And now I'm adding this into my equity side of things. And it's a phenomenal tool. And if I could just use that and pour that back into other investments, it's like, man, as Troy, who is kind of the co-founder of this, says, momentum begets momentum. And it's super exciting. So if you want to explore that more, we have on our website, we have remnantfinance.com/options. You just go there and it's going to take you to the copyright page. It's a long read. It's a 30-minute read. But if you can't put that 30 minutes in there, don't sign up. But then when you go there, if it makes sense, like, and you get a little overview of what the goal is there, I think this is an absolute game changer. So you're going to hear a lot more about this from us. And you're also going to hear our real time. Me and Brian are committing to giving our results and kind of making sure, like, if we're going to recommend something, that we're actively doing it, first of all, and we've put it through a test period where, for months now, Brian's been studying and learning and getting geared up to start, and I'm a couple weeks behind him. But like, we're going to let you know if that were to change. But I mean, this is so basic and simple. It is really truly low stress trading.
Yeah.
So,
and it's the other side of that. It's selling options to those who want to speculate, which in my mind, I think of it as selling insurance. It's like selling car insurance. You promise, hey, I'll buy it from you. I'll take care of it if it crashes on you. If you crash, it's very similar to that. But you receive the premium, and then most of the time nothing happens, and you keep it. And then on the other side,
buying it,
yeah,
just like insurance, they don't want to have a claim. Like they want it's insurance for them. They want their stock to go up. So it's a really cool strategy. Remnantfinance.com/options, or reach out to one of us, and we can get you spun up there. So, Joe, you got anything else?
Man, I think this was great. I really appreciate you having me on. It's always a pleasure to come chat. If I can ever be of a service with anything, please just let me know. And I just really appreciate all the good work you guys do, Hans, man. Thank you very much.
Well, thanks for coming on again, and we look forward to the next time. All right, everybody.
All right. See you guys.
Have a good week. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.